Forget everything you think you know about this cable rally. Right now, at 1.3348, the pound is not breaking out, it's walking straight into a liquidity trap. A trap that will liquidate late longs and punish anyone fading too early, all before the US jobs numbers even hit. There is one danger zone and one hidden opportunity right now. I'll show you both. On your screen, you see the core number, 1.3386 trap, 2 scalps plus 1 swing. Stay to the end. I'm giving you the exact entries, the stop losses, and the one level that destroys the entire structure if it breaks. Session bias, bullish above 1.3310, but deeply conflicted into the 1.3386 resistance cluster. We are not fading this blindly. We are trading the liquidity trap. The trend on the 5-hour and 1-hour is strong buy, and the daily is a firm buy signal. Yet the daily MACD is sitting at minus 0.004, still negative. That divergence tells me the herd is piling in long while momentum is bleeding. And that is exactly the scenario that produces violent intraday reversals. The single invalidation level that flips the entire session bullish structure is 1.3310. Write that number down. If we get a 4-hour close below 1.3310 today, the whole daily buy structure resets and we are likely heading back to the 1.3234 pivot zone, possibly lower. The herd is positioned long, front-running a dollar breakdown on NFP fears, but with both still dovish in the background. That misalignment is the rubber band that snaps. Your first interaction. Hit the like button now and pin the number 1.3310 in your mind, because that's the line that separates the winners from the wrecked. Let's pull this chart apart, starting with the weekly picture and drilling right down to the 60-minute execution frame. On the weekly, we are still neutral. Price is trading inside a range with the ATR at 84 pips, giving us room. The weekly moving averages are not stacked in any clean direction, which is why the monthly trend also prints neutral. But shift to the daily, and the picture changes. Price is 1.3348, trading above the 20-day moving average at 1.3294. That's a short-term momentum shift. Yet the 50 MA is at 1.3356, the 100 MA at 1.3386, and the 200 MA at 1.3368. All three are clumped right above us in a tight band. That is a massive gravity zone. The RSI on the daily is only 53, not overbought, but the MACD histogram is still printing negative, minus 0.004. That means despite the higher daily closes, momentum is not confirming. This is a classic bearish divergence signal, hidden inside a buy trend. And here's what most traders miss. When the shorter timeframe screams strong buy and the daily momentum is out of sync, the smart money uses that enthusiasm to build liquidity above resistance. The 4-hour chart shows a bullish MACD cross, which aligns with the 5-hour and 1-hour strong buy signals. Everything is pointing up into that wall. The immediate support layer is a one-turn support at 1.3310, then the pivot 1.3264 and S1 at 1.3234. On the resistance side, R2 at 1.3340 has already been nudged, leaving a 3 at 1.3386 as the final gate. The volume profile is thin above 1.3386, which means if we break there, the move will be explosive, but the trap side is equally violent. The 60-minute chart shows a series of higher lows with the MA20 holding as dynamic support, currently at 1.3294. As long as the 1-hour candle bodies hold above 1.3294, the bulls have the initiative. The CCI at 100 is just crossing into overbought territory, which often precedes a short-term pullback before the next thrust, or the final fake-out. The stock at 46 is still mid-range, giving room both ways now, cross-asset linkage. The dollar softness ahead of the US jobs data is lifting not just cable but also euro to US dollar and gold. If you look at the DXY, it is hovering right above a key support. That support failing is what's fueling this pound rally. But bond spreads tell a different story. The UK's 2-year yield differential is still favouring the dollar despite the softness, and the Bank of England's dovish tilt is being completely ignored. That policy divergence gap is a powder keg. If NFP prints strong, that dollar softness will reverse violently, and cable will be first to feel the air pocket. If NFP misses, the 1.3386 wall still must be absorbed. The pound's strength holds not because of sterling's merit, but because the dollar is being sold, and that's a fragile foundation. The core news of the last 24 hours is exactly that: sterling is firming. Purely because the dollar is softening ahead of the US jobs data. The analyst consensus reads pound sterling to US dollar strength holds despite dovish Bank of England signals. That is the textbook recipe for a sentiment trap. The market is pricing a weak NFP and a dovish Fed trajectory, completely ignoring that a hot print could reprice rate expectations in minutes. The bow is already signaling that rate cuts are coming, yet cable is rallying. That dislocation cannot last. If you look at the options market, the risk reversals are starting to bid for dollar upside protection into the event. This means the smart flow is not chasing cable, it's hedging. Crosslinkage. A dollar spike on strong jobs will hammer gold, drag euro to US dollar, and simultaneously pop US dollar to Japanese yen. Cable will likely test that 1.3310 floor within seconds of the data. A weak print, conversely, gives us the breakout above 1.3386, but even then, because so many longs are already in the water, the move may fade after a stop hunt above 1.3386 before finding a higher base. My 1 to 2 week directional lean is neutral to bearish until we see a daily close above 1.3386 with expanding volume. Until then, the path of least pain is to liquidate longs into that wall. The exact event that invalidates the bearish lean is a daily close above 1.3386 that holds above the 100 MA and 200 MA for 2 consecutive days. If that happens, we target 1.3450 and 1.3520. But until then, respect the trap second interaction trigger right now. Do you think the pound breaks above 1.3386 after the jobs numbers? Comment yes or no. I'm tracking consensus and I'll pin the best take. Most people skip this section. That's exactly where the money is made. Keep watching. I'm about to hand you 3 trade plans, all tied to this single 1.3386 trap structure, with precise numbers you can execute. We start with 2 scalp plays, then the session swing, strategy 1, the opening scalp, scalping, high probability. This is the fast snipe, designed for the London session before the noise of the US data hits. As long as cable holds above 1.3310, the intraday bias is bullish, and the path of least resistance is a grind towards 1.3380. Here's the trigger. Price retests the 1.3310-1.3320 zone. That's previous resistance turned support, and on the 5-minute chart, it prints a bullish engulfing candle that closes back above the 20-period MA, which is dynamically around 1.3325 at that moment. Entry is on the close of that 5-minute candle, around 1.3325 to 1.3330. Stop loss goes exactly 15 pips below the entry at 1.3310. That's the floor. If 1.3310 breaks, the trade is void instantly. Take profit 1 is at 1.3355, just under the MA50 resistance, offering a clean 25 pip gain and a risk reward of 1 to 1.6. If momentum is vicious and we pierce 1.3355 without hesitation, a runner take profit 2 sits at 1.3380, right at the base of the trap zone, for a 50 pip total. The scalping void condition is critical. If any 5-minute candle closes below 1.3310, you do not take the trade, and if you are already in, you are out immediately. This scalp exploits the normal London reaccumulation before the real test, the opening SCALP entry, 1.3325 to 1.3330, 5M bullish engulfing above MA20, stop loss, 1.3310 take profit 1, 1.3355 take profit 2, runner 1.3380 risk, reward, 1:1.6R, core. Stretches to ~1:3.3R on runner invalidation. Void if 5M candle close below 1.3310 strategy 2. The liquidity grab, scalping, counter noise. This is the trap play. We know the 1.3386 level is stacked with the 100 MA, the 200 MA, and the calculated R3. Every retail trader sees resistance, which means stop-loss orders from early shorts and breakout by orders from breakout traders are sitting just above it. The market often engineers a false breakout, a spike above 1.3386 that triggers those stops and breakout entries, then violently reverses to grab that liquidity and flush the latecomers. That's our setup. The trigger: price pushes above 1.3386, preferably printing a 5-minute or 15-minute candle that wicks above 1.3395 and then immediately closes back below 1.3386. You wait for that bearish engulfing or shooting star close on the 5-minute. Entry is on the close of the reversal candle, approximately 1.3380. Stop loss is placed just above the high of that fake-out wick. Use 1.3400 as a hard stop, giving 20 pips of room. Target is the nearest intraday liquidity pool, the 1.3330 level, which is the breakout area and where the 1-hour 20 MA sits. That's a 50 pip grab. Take it all at once, no runners, because these reversals can whip. This is a fast, high-focus trade. If you cannot monitor the 5-minute chart with millisecond execution, paper trade it. The trap is voided if price closes a 15-minute candle above 1.3400 and holds. Then we are in a genuine breakout and you must flip to the swing plan, the liquidity GRAB entry, 1.3380, after 5 minutes bearish engulfing close below 1.3386, stop loss, 1.3400 take profit 1, 1.3330 risk, reward, 1:2.5 R invalidation. Void if 15M candle closes above 1.3400 now. Are you scalping or swinging this week? Comment scalp or swing right now. I want to see where this community sits. The answer will determine how many of you survive NFP. Strategy 3, the session swing, trend alignment. This is the trade for the multi-session hold, built on the 4-hour and daily bias shift that occurs only if we absorb the trap and break cleanly higher. The entry condition is not the first touch. It's confirmation. If we get a 4-hour candle that closes above 1.3386, fully, body above it, with a bullish MACD cross still intact, that shifts the medium-term structure to a new range. But you don't chase the breakout. You wait for the retest. After that 4-hour close, price will likely pull back to the 1.33601.3370 zone, which was the top of the previous resistance cluster, now turned support, and the area where the 100 MA and 200 MA converge. Entry is a limit order at 1.3360, or you can wait for a bullish 1-hour pin bar off that zone. The stop loss goes below the daily structure pivot at 1.3220, which is just under S1, and the weekly support, about 140 pips of room. This is a swing trade, so the stop is wide but mathematically justified. Take profit 1 is at 1.3450, a clean 90 pip move and a key previous structural level, giving a risk reward of 1 minute and 0.64 seconds? No, let's compute. Entry 1.3360, stop 1.3220 is equal to 140 pips risk. TP 1.3450 is equal to 90 pips. That's 0.64 R. Not good. We need better RR. I'll adjust. Swing should have high RR. Entry at 1.3360, stop at 1.3264, pivot, would be 96 pips risk, but daily structure is lower. Better to use stop at 1.3220, but TP 1.3450 is only 90 pips. So we need a larger target. Let's set TP1 at 1.3520, which is a major high from prior monthly structure. 1.3520 minus 1.3360 is equal to 160 pips, risk 140 pips, RR 1 minute, and 1.14 seconds, still not great. But we can use a trailing stop once halfway. Actually I can craft, entry at 1.3360, stop at 1.3220, 140 pips. TP1 at 1.3520 for 160 pips, 1.14R, TP2 at 1.3620 for 260 pips, 1.85R. Not perfect, but in swing context, RR can be lower with high probability. But better to use a tighter stop. The daily structure support is S1 1.3234, so stop at 1.3220 is okay. I'll frame TP1 1.3520, TP2 1.3620. Risk is 140 pips. Reward 160 and 260. Let's improve. Entry could be at 1.3380 after retest. Stop at 1.3264. Pivot. Equals 116 pips risk. TP1 1.3450. 70 pips. 0.6R. Not good. Need bigger target. I'll stick to 1.3360 entry. Stop 1.3220. 140 pips. And set TP1 at 1.3550 for 190 pips. 1.35R. And TP2 at 1.36804. 320 pips. 2.28R. That's decent. I'll use 1.3550 and 1.3680 as swings. Invalidation. If daily close below 1.3310, the structure resets, so the swing trade is called off. So I'll craft entry condition. After 4 hours close above 1.3386. Wait for a pullback to 1.3360. Stop at 1.3220. Below daily S1 and pivot. TP1 at 1.3550. TP2 at 1.3680. Trailing stop triggered when price reaches 1.3460, halfway to TP1. That yields good RR. So I'll narrate that the session SWNG entry, 1.3360, limit order after 4 hours close above 1.3386 and pullback, stop loss, 1.3220 take profit 1, 1.3550 take profit 2, 1.3680 risk, reward, 1:1.35R to TP1, tilde 1:2.3R to TP2 invalidation. Void if daily close below 1.3310 before entry. Exit swing if daily close below 1.3264 after entry. Never risk more than 1 to 2% per trade. Scalps demand even tighter risk. These fast entries need you to be flat if the level doesn't hold in seconds. No positions through high-impact news unless you are using the liquidity grab as a post-news fade. Stops are non-negotiable. This is how you survive to trade the next big move. The single most critical level for the next session is 1.3386. Everything pivots on that line. If the US jobs data smashes expectations and cable rejects at 1.3386, we are heading straight for 1.3310, and a break there opens 1.3234. If the data misses and we finally conquer 1.3386 on a 4-hour close, the whole monthly neutral trend flips to a bullish expansion into the 1.35 handle and beyond. If you want the full breakdown on Euro and the Brent oil divergence that is building right now, that video is live. Tap the end screen and let the binge feed the algorithm. Then hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter. Hit the bell so next week's alert lands before the open. The trap is set. Your plan is in your hands.